Good morning, everyone. Hello and welcome to the weekly commodity audiocast. I am Kaina Chenwala from Kotak Securities Commodities Research Desk, your host for today, and we will be discussing ongoing developments in the commodity markets, factors influencing market sentiments, and uncovering the latest trends. So let's get started and delve deeper in this ever-changing world of commodities. In the previous week, hopes for a second rate cut in 2024 were renewed after a weak US labor report, which offered some relief to the markets during an otherwise tense week. Disappointing economic data from the US, coupled with a less hawkish stance from the Federal Reserve, drove the dollar below the 105 mark. US ISM manufacturing PMI dropped to the contraction territory to 49.2 in April from March 50.3, and official job openings fell to a 3-year low of 8.5 million in March. These figures hinted that the US economy may not be as robust as previously thought. In the much awaited FOMC meeting, the Fed held its benchmark short term borrowing rate steady at 5.25% to 5.5% as widely anticipated. However, it announced a slowdown in the pace of balance sheet reduction from $60 billion to $25 billion per month starting in June. However, what drove markets in the positive territory, or what drove the market sentiments positive, was that Fed Chair Powell downplayed concerns of a potential rate hike, though he emphasized the need for more evidence that inflationary pressures are cooling before considering a reduction in borrowing costs. This was perceived as less hawkish than expected and brought relief to traders who were worried about a more aggressive Fed response to signs of sluggish inflation progress. This pushed the dollar down from its 2-week high of 106.49 levels to below 105 levels in the subsequent sessions. The softer than expected US jobs report increased bets of an earlier than expected rate cut from the Fed, erasing all the gains Greenback made over the previous 3 weeks. Also, it led to a positive momentum in the equity markets, helping most global equities to close the week on a slightly positive note. Moving on to commodities, COMEX gold prices experienced its second weekly decline, dropping below $2,300 per ounce on easing geopolitical tensions, expectations of fewer rate cuts for the year, and a more positive outlook for global economic growth. The OECD, the Organization for Economic Cooperation Development, revised its outlook for the global economy upward, citing stronger than expected growth in the US and China. According to the Paris-based organization, the global economy is forecasted to grow by 3.1% this year and 3.2% in 2025, both representing an improvement from the previous forecast in Feb, which expected growth of 2.9% in 2024 and 3% in the following year. Nonetheless, gold still managed to limit its losses to below 2%, as Fed Chair Powell signaled that rate hikes are unlikely and expressed confidence in the current policy's ability to achieve the 2% inflation target. Conversely, silver fell 3% in line with weaker gold and softer industrial metals. LME base metals ended the week on a mixed note, as expansion in China's manufacturing PMI buoyed hopes of a sustained recovery in the top consumer, while delays in demand uptick during the seasonal construction period weighed on consumption outlook. Of all the metals, copper and aluminium were the ones that closed on a negative note. So copper was largely weighed down by reports suggesting that China's copper producers might increase exports in the coming weeks, while aluminium slipped as LME on-warrant stocks surged by 88,625 tons, the highest since March 2023, after previously ordered aluminium out of South Korean depots was returned to the LME system. Meanwhile, crude oil experienced significant losses, with WTI prices plunging by almost 7% to a 2-month low and closing below $78 per barrel. It also marked the largest weekly decline since February. It could be attributed to fading geopolitical risks, an unexpected surge in US crude oil inventories, and declining gasoline demand ahead of the summer driving season. US inventories have been steadily rising, with 12 out of 17 weeks since the beginning of year showing increase. Also attributed to higher output and weak demand. Gasoline demand plummeted to its lowest seasonal level since 2020 based on the 4-week average of product supplied as we enter the peak summer driving season. Now, oil prices are likely to continue to face downward pressure as Hamas is reportedly exploring a temporary ceasefire proposal with Israel and has sent a delegation to Egypt for further negotiations. On the price action front, MCX crude oil May on the weekly chart has faced resistance near its falling channel, affirming bearish presence. Also, price is trading below its parabolic SAR, which will act as a dynamic resistance. So next support for the counter is placed at 6300, below which major support is placed at 6120 levels. Talking about gas prices, NYMEX Henry gas prices rallied by 12% last week, buoyed by reduced output and increasing LNG flows, with the Freeport terminal expected to resume full operations by mid-May. Additionally, EIA inventory data aligned with expectations, showing lower injections compared to last year. The EI inventory report indicated the US utilities added 59 BCF of natural gas to storage during the previous week compared to 5-year average addition of 72 BCF. US gas prices are likely to see further gains as the Freeport LNG terminal is expected to resume full operations this month. Talking about price action, on the weekly chart, MCX natural gas May contract has formed a bullish engulfing candlestick pattern, confirming a bullish reversal. In addition, stochastic 6 has provided a fresh positive crossover. So the next resistance for the counter is placed at 192.5 rupees, above which the major resistance is placed at 200.80. So now that the much anticipated US labor report is out, and uh, it's likely to just have a very temporary positive impact, as it only points to a moderation and clearly not an unexpected weakening that the Fed said it may warrant to lower borrowing costs. The Fed would like to see sustained weakness in wage growth after average hourly earnings rose 0.2% month on month and 3.9% year on year, the slowest pace since June 2021. Nevertheless, signs of emerging stress in the labor market, with non-farm payrolls advancing by just 1,75,000 last month, smallest gain in 6 months, and the unemployment rate ticking up to 3.9%, has pushed bets of a September rate cut to 80% and added to wagers of a second rate cut in the November or December meeting. Also, swap traders pulled forward bets on the first Fed rate cut to September from December. So, looking ahead, speeches by FOMC officials will likely play a significant role in shaping market expectations regarding Fed pivot. Meanwhile, the Bank of England's upcoming policy decision is also on investors' radar, especially given the backdrop of weak growth and cooling inflation in the UK. However, the MPC's internal divisions on the timing of potential rate cuts adds another layer of uncertainty regarding the timing of the first rate cut in 4 years. On the data front, final services PMI may help traders assess pace of business activity in April, while UK GDP and US consumer sentiment will throw light on the economic health. Overall, the soft US labor report seems to have added some optimism into the markets, with increased anticipation of one or two rate cuts, more than one rate cuts to be precise, in 2024. However, the uncertainty still lingers, and market dynamics will likely continue to evolve in response to incoming data and central bank actions. So, on that note, we conclude this session of Commodity Audiocast, and we hope that we've offered you valuable insights. So, thank you so much for tuning in today, and we eagerly anticipate your presence with us again next week. Until then, happy trading. Thank you so much.